Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the real story behind corporate filings. And let me tell you, this report for Exchange Place Advisors Trust has some eyebrow-raising moments, especially when it comes to how this fund is managed and where it is headed. So grab your popcorn, because we're about to decode the financial health and future plans of the Pitt Capital Total Return Fund. We're looking at a certified shareholder report from the US Securities and Exchange Commission, a document that gives us a peek under the hood of publicly traded investment companies for the Pitt Capital Total Return Fund. This report for the period ending the 31st of October 2025 paints a picture of past performance, current holdings, and some significant upcoming changes. First off, let's talk about how the fund performed. For the 12 months ending the 31st of October 2025, the fund returned 19.14%. That sounds pretty good, right? But here is where it gets interesting. The S&P 500 index, which is a common benchmark, did a lot better, returning 21.45% in the same period. So while the fund made money, it actually underperformed its benchmark. The report says the top performers were companies like Broadcom, Lam Research, Advanced Micro Devices, and Alphabet. These are all big tech names, and their success was largely tied to the boom in artificial intelligence spending. Makes sense. But the report also points to the biggest underperformers. These included Zebra Technologies and Fiserv in the tech sector, Arthur J. Gallagher and Apollo Global Management in financial services, and Lululemon Athletica in consumer discretionary. This diverse mix of underperformers is a key reason why the fund didn't match the S&P 500. It's like having a sports team with a few star players, but a lot of others who are just not scoring goals at the same rate. Let's look at the long-term performance. If you invested $10,000 in the Pitt Capital Total Return Fund back in October 2015, by October 2025, it would be worth about $31,156. That is a solid return, but if you had put that same $10,000 into the S&P 500, you'd have a much heftier $39,196 over 10 years. The S&P 500 has significantly outperformed this fund. This is a pretty stark difference, and it tells us something about the fund's strategy compared to just broadly investing in the market. Looking at average annual returns, the story is similar. The S&P 500 averages 14.64% over 10 years, while the Pitt Fund averages 12.03%. Again, the fund lags behind. It is important to remember though, the fund is the successor to another fund, so this performance history is looking at that predecessor fund's record before the 28th of June 2024. Now, let's check out some current stats. The fund has net assets of about $64.5 million. It holds 28 different investments, which is a relatively concentrated portfolio. The portfolio turnover rate is 27%, meaning they buy and sell investments fairly often, which can lead to higher trading costs. The top 10 holdings give us a clearer picture of where the money is. Big names like Advanced Micro Devices, Microsoft, and Alphabet are at the top. This confirms the fund's heavy leaning towards technology and growth stocks, especially those benefiting from AI. Looking at the sector breakdown, technology is the largest slice of the pie at 37.6%, followed by industrials at 20.4% and financials at 15.8%. This heavy concentration in specific sectors, especially technology, means the fund's performance is very tied to how these sectors do. If tech takes a hit, this fund is likely to feel it more than a more diversified fund. But here is the really interesting part and something to pay serious attention to. There are some big proposed changes coming. The current investment advisor, Kovitz Investment Group Partners, LLC, is going through an internal restructuring. This basically means that at the end of December 2025, their assets and liabilities will transfer to a new company called Focus Partners Wealth, LLC, which is also part of the same parent company. This is a significant structural change. Even more significantly, the fund itself is proposed to be reorganized. Right now, it is an open-end mutual fund. The plan is to move all of its assets and liabilities into an exchange-traded fund or ETF, called the Kovitz Core Equity ETF. This is expected to happen in the second quarter of 2026. Pending shareholder approval, this is a big shift from a traditional mutual fund to an ETF structure. The Board of Trustees has approved this plan and recommends that shareholders do the same. They've also approved a new investment advisory agreement with the new advisor, Focus Partners Wealth, LLC. The good news is the investment strategy, the objective, and the team managing the money are expected to stay the same. So, even though the structure is changing and the advisor entity is changing, the core investment approach should remain consistent. However, if the reorganization into an ETF doesn't happen, shareholders will still be asked to approve the new advisory agreement. Let's touch on costs. for a hypothetical $10,000 investment. The costs for the last year were $110, which is 1.00%. These costs are what you pay for the fund to be managed. They seem reasonable, especially since the advisor has agreed to waive fees to keep the expenses at this level. Regarding the accountants, the audit fees for the year ended the 31st of October 2025 were $17,200, and the tax fees were $3,250. These are standard expenses for a fund. Diving into the schedule of investments as of the 31st of October 2025, we see the fund holds common stocks valued at over $64.2 million. The cost of these investments was $28.9 million, meaning there is significant unrealized appreciation, which is a good thing. There is also a small amount, less than 0.5%, in money market funds. This is typical for liquidity. The statement of assets and liabilities shows the fund's net assets at $64,539,850. Liabilities are pretty manageable, totaling just over $92,000. On the statement of operations for the year ended the 31st of October 2025, we see dividend income of over $612,000. Total expenses were around $746,000, but after a fee waiver of $149,000 from the advisor, net expenses came in lower. The fund also had net realized gains of over $11 million. And a slight change in unrealized depreciation on investments, resulting in a net increase in assets from operations of over $10 million. The statements of changes in net assets show a total increase in net assets for the year ended the 31st of October 2025 of over $875,000. This is driven by operations, but offset by distributions to shareholders of over $10.5 million. The financial highlights table is always a good place to see the per-share performance and key ratios. For the year ended the 31st of October 2025, the total return per S-share was a solid 19.14%. The ratio of net expenses to average net assets after fee waivers is 1.00%, which is consistent. And finally, scrolling through the notes to the financial statements, we get more context. Note 1 explains the reorganization of the fund and how it is a continuation of a previous fund. Note 2 outlines their accounting policies. Note 3 details how securities are valued and that all investments are considered level 1, meaning they are valued using unadjusted quoted prices in active markets. This is good news as it means the valuations are based on readily available market data. Note 4 explains the investment advisory fees and other expenses and importantly mentions the advisor's fee waiver. Now, let's look at the big picture. The Pitt Capital Total Return Fund has a history of lagging behind the S&P 500 index over the long term. While its recent annual performance is positive, it still falls short of the broader market. The fund is heavily concentrated in technology stocks, which can be a double-edged sword. It means when tech is booming, like it has been with AI, the fund can do well, but it also introduces significant risk if the tech sector faces a downturn. The upcoming reorganization into an ETF is a major event. ETFs often have lower fees and can be more tax efficient than traditional mutual funds, which could be beneficial for investors. However, the success of this transition will depend on shareholder approval and the actual performance of the new ETF structure. The fact that the investment strategy and advisory team are expected to remain the same is a positive sign that the core investment philosophy won't be disrupted. The key takeaway here is that while the fund has delivered positive returns, investors should be aware of its underperformance relative to the S&P 500 and its significant sector concentration. The shift to an ETF structure could be a positive development, but it is crucial for shareholders to understand the details and vote accordingly. Alright? That is our deep dive into the Exchange Place Advisors trust filing for the Pitt Capital Total Return Fund. What are your thoughts on this fund's performance and its upcoming transition to an ETF? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate and financial insights. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching and I'll see you in the next video.